Did you know gold prices have surged nearly 45% this year and now trading close to $3,850 per ounce? And this remarkable rally has been driven by a combination of factors: a weaker US dollar, rate cuts by the US Federal Reserve, persistent geopolitical tensions, and strong investor and central bank demand. But what lies ahead? While some of these drivers may persist, the path forward will depend on how global trade tensions, inflation, and monetary policy evolve. Why investment in gold still matters. Despite the recent rally, we are of the view that gold could remain a strategic long-term asset. Here's why. Fed pivot and recession risk. Historically, gold has performed well during rate cut cycles and economic slowdowns. Any signs of a soft landing or recession could further boost demand for safe haven assets. Central bank buying. In 2024 alone, central banks purchased a record 1,086 tons of gold. A recent World Gold Council survey shows 95% of central banks expect global reserves to rise, a strong vote of confidence in gold's enduring value. A geopolitical risk premium. Ongoing conflicts from Eastern Europe to the Middle East continue to elevate gold's risk premium, reinforcing its role as a geopolitical hedge. ETF inflows. Global gold ETFs have seen $50 billion in inflows year to date, matching levels last seen during the COVID-19 crisis. Dollar and yield volatility. As interest rates ease, pressure on the dollar and yields could support gold prices further. US trade policy uncertainty. Aggressive trade stance and tariff threats under the Trump administration may fuel market volatility and drive demand for gold as a hedge. In the long run, we are of the view that the overall market environment could be favorable for a strategic allocation in gold as a long-term investment in your portfolio. Investors may consider accumulating on dips, keeping in mind gold's role as a hedge, a diversifier, and a store of value. While gold continues to shine as a strategic asset in today's uncertain world, there's another precious metal that's been quietly outperforming, and that's silver. Silver has outperformed gold this year, rising nearly 60% YTD to around $47 per ounce. This surge is backed by strong investment demand, a supply deficit, and supportive macro trends. So why is silver gaining spotlight? Here's why. Safe haven in volatile times. Trade wars and global uncertainty continue to support silver's defensive appeal. Rate cut tailwinds. Like gold, silver also benefits from a low interest rate environment. Industrial demand recovery. Economic recovery in China and developed markets is boosting demand for industrial metals, including silver. Solar and renewables boom. Silver is a key component in solar panels. With installations lagging behind production, demand is expected to remain strong. Supply constraints. Only 28% of silver comes from primary mining. The rest is a byproduct of other metals, making supply vulnerable to broader mining trends. Gold-silver ratio. Currently hovering around 85, this ratio suggests silver is still undervalued relative to gold, offering potential for outperformance. Silver has shown impressive momentum driven by investment demand, industrial recovery, and supply constraints. But unlike gold, silver is a developing growth story, one that's closely tied to the pace of global industrial recovery, especially in sectors like renewables and electronics. The long-term outlook remains promising, but investors should be mindful of short-term volatility and macro headwinds. At Tata Mutual Fund, we are of the view that gold and silver offer distinct yet complementary roles in a well-diversified portfolio. Gold provides potential stability and protection in times of uncertainty, while silver offers growth potential, especially as industrial demand and green energy trends accelerate. So don't wait. Grab the opportunity and make gold and silver a part of your portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.